Emerging market equities saw their first monthly outflows in over a year and a half. That's according to BlackRock, which points to investor nervousness surrounding the ongoing trade tensions between the US and China. Joining me now is Karim Chedid, investment strategist at BlackRock. Karim, thanks so much for coming in. So what have you been seeing in terms of flows?
So looking at the flows across the ETF industry globally, we have started to see some outflows from emerging market equities. The past month was the first one in a year and a half. And we have seen some money go back into European equities, which is interesting because it really feels like the contrarian view at the moment. Not many investors seem to be very optimistic about the outlook in Europe, especially because of the renewal of political risks in Italy and the reintroduction of risk premia to European assets, both stocks and bonds. So it's interesting to see those flows. They don't tie in with the macro view per se. But EM outflows for sure a little bit the past month, and we've also seen a return of inflows into US equities.
Okay, so what's driving this shift away from EM? Is it purely a trade tensions play?
I think there's a couple of reasons that this near-term volatility in EM has happened. One is the trade tensions, and the reason why the trade tensions do matter, especially those tit-for-tat headlines that we're seeing between the US and China, is that the global growth picture has become a lot more concentrated in those regions. So we're not seeing much growth in other parts of the world. Really, global growth is still positive, and we're quite constructive on the macroeconomy globally, but it's mainly driven by the US and China. So if one of them turns around, it's negative for global markets. It would be negative for global markets. So it's not a surprise that sentiment has become sensitive to those headlines. And it's also not a surprise that EM has taken a bit of a beating because of that. The other reason at play, other than the trade tensions, is that we have seen the Fed move their view on rates a little bit more hawkishly. So we're seeing the Fed likely hiking rates 4 times this year and maybe even 3 times next year. And the dollar has strengthened as well. And those factors tend to be associated with a more negative environment for emerging markets, at least in terms of how the flows are going.
So given all those risk factors, how come you're still constructive towards EM?
Great. I mean, yes. So all the factors that I just described are potential reasons why we're seeing some selling. And the selling is a fact. We have seen some selling the past month. The point we're trying to make is we don't think this is going to be a persistent trend. A bit of a correction in an EM-DM outperformance cycle does happen. And this is this past month of EM underperformance and EM outflows is a typical mid-cycle correction, which means that it's just a correction. We think the outperformance cycle of EM to DM is likely to continue. And there's a few fundamental reasons why. I mean, firstly, we see that the EM economy is still quite strong. Growth there is higher than, and likely to stay higher than in DM. We think EM can withstand the higher dollar because fundamentals for EM have become a lot better in terms of financing. And there's many parts of EM that are more resilient to those trends than others. So some of the negative headlines that we see associated with foreign capital outflow are relevant for an EM economy like Turkey or South Africa, but less so for other EM economies.
So what have you been seeing in terms of flows within the debt space? I know that you're constructive, obviously, on EM debt. Is that more a hard currency or a local currency view?
So on the EM debt level, we are seeing differentiation between the two, the hard currency and the local currency. Most of the inflows that we are seeing are into hard currency, not local. And it's not a surprise given the dynamic with the dollar strength and the volatility of EM local currencies. We think that the dollar EMD view has a bit more to go. We're not necessarily, what we're saying is that dollar EMD is one of the areas which are still relatively stable in an environment where the bond environment is difficult. So it's a relative call. And the dollar EMD view is basically, I mean, with yields back up at about 6% for a dollar EMD exposure, that's pretty decent yield that you can pick up at not very high volatility. So it looks good compared to, say, dollar high yield, where the yield is comparable, but the volatility is a lot more.
So does that mean that you prefer EM equities? Because I know that that was one of your top conviction calls at the start of the year, and that hasn't necessarily worked out so far.
Yes, it's still a preference for EM equities, and we like EM equities from a strategic perspective. So we think that the outperformance cycle of EM to DM, which started in 2016, has more to run over the long term. So there's a bit of patience with that call, and really it is a preference for EM equities, but there is some differentiation as well within the EM equity space.
Well, so EM obviously is a very broad term. There must be some sectors or countries
Exactly.
that look more attractive. Which ones are those?
Yeah, so there is differentiation in that call. I mean, not all EM is the same. I do have to say that when you look at a broad EM equity index, most of the mainstream indices that ETFs track tend to be very overweight, not overweight, but have a very high weight in Asia. So about 70-75% Asia. So when you talk about a broad EM call, it really matters what you think about Asia. And we like Asia. Asia is our top regional pick within EM, so that's at a regional level. At a single country level, there's interesting stories in China, where growth is proving quite resilient. There's interesting stories in India, where you have a long-term reform case towards a more sustainable economic structure. And there's also interesting stories in Southeast Asia, where the consumer story is quite strong.
And what about Russia? Given the sanctions story, obviously we've seen asset prices sell off significantly. Would this be a good opportunity to buy cheap here?
I think with Russia, it's hard to call it because the vulnerability to those trade headlines and the sanctions, more the sanctions actually, is quite high. So it's a bit hard to call it. The other factor you need to have a view on when you're looking at Russia is oil. Now the oil price has gone up. It's a different regime to where we were last year. It has gone up, but there is news about a potential OPEC deal, potentially even today, although Iran has made some noise about not wanting to be part of that deal, to increase supply. Will it be enough to overcome the shortfall that we're seeing from Venezuela and Iran supply? Probably not, so maybe not a huge mover for the oil price, but you need to have a view on the oil price for Russia.
Okay, Karim, thank you so much. That was Karim Chedid, investment strategist at BlackRock, talking us through the investment case in emerging markets. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.